The year of the tariff continues. Hello and thanks for checking out this week's fastest 4 minutes in finance. I'm Scott Inman. At the time of our recording, the S&P 500 index is down more than 15% year to date, and it has lost almost 12% in just the past week. The sharp sell-off, as you know, started on the so-called Liberation Day when President Trump announced sweeping reciprocal tariffs on basically the world. Well, we focused on the tariffs last week from the standpoint of keeping the proper perspective. Investors have overreacted to the news of the day without having any real understanding of what the long-term trade policy will be or the impact thereof. This week, we take a look at some possible outcomes. The president's actions are no doubt creating a radical change from the way the United States has traded with other countries for really most of the past century. A chart from T. Rowe Price shows that. The effective tariff rate, which is defined as U.S. tariff revenue divided by the value of U.S. imported goods, was at 3.1% at the beginning of the year. And you can see that's historically very low. If the full reciprocal tariffs are left in place, T. Rowe estimates that the effective tariff rate would jump to 15.6%. And that's a level we have not seen since before World War II. And it's also important to note you won't see anywhere on this chart that tracks the tariff rate all the way back to 1930 as sharp of an increase as the president seems to be implementing all at once. Any kind of change of this magnitude would certainly create uncertainty. So what could happen? That depends greatly on what the president's ultimate goals are. Let's consider three possible goals and outcomes from Tim Murray, a capital market strategist for T. Rowe Price. First, if the president's goal is to strengthen the U.S. trade negotiating position, the U.S. runs trade deficits with most countries. If he's simply trying to even the playing field, long-lasting tariffs would likely be more painful for other countries than for us, and this could give the president leverage to reduce trade barriers. That could make the higher tariffs short-lived and would minimize the economic impact. If the president is touting the benefit of the increased revenue from higher tariffs, this could create higher tariffs for longer. That's the second possible outcome. Murray writes that in theory, that could help reduce the U.S. government's giant budget deficit, but he says that'll only work if the negative impact of tariffs on the economy does not offset any potential gains in tax revenue. And last, if the president is focused more on tariffs bringing more manufacturing jobs back to the U.S., it could also create higher tariffs for longer. Murray believes the higher tariffs could make it cheaper for U.S. and foreign companies to shift production here, but he writes that would almost certainly raise manufacturing costs and could take years to implement. As we said last week, so far tariff concerns have not impacted the economy, even though it has impacted the stock market. But trade uncertainty among businesses and consumers have reached the highest levels since the COVID-19 pandemic, and that could put some spending on hold and even send us into a recession, creating a self-fulfilling prophecy. It highlights the importance for an all-weather, diversified investment strategy as you as an investor, especially if you're close to or in retirement. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.